Welcome to Markets Today. I'm your host, Mbithe Mwema. It's the middle of the week, 3 more trading days before the week ends, but we did see a lot of activity yesterday on the Nairobi Securities Exchange. I will walk you through what happened yesterday, what were the foreigners doing, what were the local investors doing, and I'll also give you an overview of corporate news that has come through overnight that could possibly affect your investments. Later on in the show, we will be having a deep dive and looking at the SMEs in this country. What are the challenges that are facing them pre and post-COVID? What are the options that are available to them from the government? And what we are trying to understand is what does the SME activity mean and look like, and what trickle-down impact could it have on some of the industries, either as banks or on government operations in as far as revenue generation is concerned. That's a conversation we have later on, and I will introduce our guest in a few. Looking back at the Nairobi Securities Exchange, yesterday, turnover actually tripled over the day, closing at 1.6 billion compared to 531 million that was traded on Monday. This activity was dominated by foreigners who made up 97% of the sales over the day and were only 34% of the purchases. We continue to see the foreigners exiting, especially out of the blue chip companies. In terms of volume, Safaricom dominated volume with 24 million shares traded at 27.9 to 29.5 shillings per share over the day. Equity was the second largest mover with 10 million shares traded at a high of 39.5 shillings per share. KCB was also up there, trading 6 million shares at 38.95. Again, the foreigners were largely on the exits in as far as these blue chips are concerned. We expect to see a similar trend, maybe not necessarily hitting the levels that we hit yesterday, but the foreigners continue to be on the side of selling out of stocks in this economy, as well as other economies in Africa, largely because of COVID pandemic and the possible impact on the underlying company operational profitability. Looking at corporate news, we have seen SME'S Africa come out with a cautionary statement overnight. And the board has approved the closure of one of its key businesses, which is the tire business. SME'S Africa had in 2016 changed the business strategy, whereas before it used to produce the tires locally. From 2016, it got into a contract manufacturing agreement with companies domiciled out of China and India to be able to buy and sell products in the tire business in Kenya. Following the COVID pandemic, there has been a negative impact on supply chains, and this has been disastrous for the company's operations. As a consequence, it has decided to close this business in entirety. The exit cost of this business is estimated by the board as well as the management of SME'S Africa at 223 million shillings. 60 million of this will be paid out as a redundancy package to the 73 employees of the company, whereas the remainder will be put out as an impairment cost for the fixed assets in the company. SME'S estimates that following the closure of this business, by the year 2021, it can be able to generate a profit of 185 million once this restructure is complete. This is a business that has been struggling, and we are beginning to see the impact of supply chain disruptions affecting some of the trading businesses in Kenya, and this is one of the larger numbers that we've actually seen come to the market. Sticking on with supply chain disruptions and also looking at the SME sector, KEPSA has come out with a 61-page report detailing the survey findings that it has gotten from about 2,643 participants, looking at what is happening in COVID and what do these businesses expect. The key findings include this. There has been revenue losses, and largely in the manufacturing and tourism and hospitality industry, with some of the businesses here reporting average losses of between 30 to 40 million. The agricultural sector has reported some losses of about 20 million based on what is happening in COVID. The majority of these businesses are split in terms of, do we hold onto our employees, do we release our employees? 46% of the respondents to the survey said they had released their employees, whereas the rest said they are holding steady to see what happens. In as far as COVID is concerned, we are seeing at a government level that we are really going back to normal. This week, we have seen politics dominate the news headlines. We have also seen the Aviation Authority come out and open up to a Zoom call to discuss the way forward in terms of opening up the Jomo Kenyatta International Airport, as well as facilitating passenger and freight flights from the national carrier. We have also seen the Ministry of Education put up a team that will be able to steer the economy and especially the education sector in preparation for opening up schools. And the estimated timelines we're looking at are June 5th. So we are seeing a lot of things coming up, and we are seeing COVID is sort of coming to an end, maybe in terms of the curfews and the restriction of movement. But what is evident from our conversations and just going on the ground is the fact that there will be a financial detriment in terms of the company operations, SME operations, and individual operations. So yes, COVID will come to an end, but then we will have the lag effect of the financial destructive measures that maybe some of this, what COVID has done will, I beg your pardon, we will have the lag effect in as far as financial measures and financial weaknesses that will stream through the different sectors in the economy. We want to look at the SMEs today and understand where are they coming from, where are they going, what can the government do for them, and what impact could they have across broad sectors such as banking or any other sectors. We are joined by Christabel Onyango. Christabel is formerly was a director of credit in some of the local banks and has been looking at credit for the last 15 years. She's well versed with some of the challenges that are facing the SMEs, and we asked her to join us via video call to help us understand what is happening pre-COVID, post-COVID, what are the challenges SMEs are facing, and what should SMEs be focusing on at this point in time. Welcome to the show, Christabel.
Thank you, Bibe.
So you do have a lot of experience just looking at credit that flows into the SME sectors and understanding the nuances that affect these businesses. Perhaps you can start us off by giving us an overview of what COVID has meant for these businesses and what situation or challenges are these businesses facing.
I think for most SMEs, the biggest challenge is declining demand for their products or their services, mainly because of restriction of movement. We realize that when people can't move, a lot of decisions, people become much more rational, consumers become much more rational. Do I really need to buy this product or take advantage of a particular service? So that is one. There's also inability to access supplies because there's supply chain disruption. We become heavily dependent, especially those who import, on China and any other country that supplies our country. So that's the second thing. The other thing is where supplies are available, they become expensive, again, because of disruption. So where they can access supply, then it is expensive. It's either expensive because suppliers are taking advantage, or the cost of transportation has increased because the transport sector is also one of those that has been heavily affected. Then there's basically the fixed costs are not making sense when revenue is not being generated or there's no activity or activity has gone down. So there's meeting fixed costs whereas revenue has declined. Yeah, so I think those are the major challenges that COVID-19 has presented for our SMEs.
In general, are there some sectors that have been hit harder than the others? I know you have just mentioned the transport sector and manufacturing sector. Maybe you can walk us through what their impact has been. What have you seen? What have you heard in your various engagements?
I think the first is what you would call hospitality or accommodation and restaurants. Those are highly affected. I think whether it is those who are serving the domestic market, those who are serving tourists, they've ground to a halt, a majority of them. People are not going out to eat. Even ordering food, people who are ordering food, people are wary before you know whether your food will come in and it's contaminated or not. Although confidence is growing, a lot more people are beginning to order, but then there was a sharp decline in the mid-March and the month of April. Accommodation, nobody's traveling, therefore accommodation is not required. If you even leave the big hotels and high-end restaurants aside, for example, if you went to a place in the CBD called Nyamakima, where a lot of businessmen transport drops them in to come and buy goods as well as take supplies. Restaurants had mushroomed around there. So you find that those are closed. People who are visiting those are probably those essential services that are still working in the CBD, for example. So there's a sharp decline in that sector. And I think that's the hardest hit, with almost, I think, a projection of about 50% decline in activity. I think the other one that follows, education is another. Child is you have the private sector schools, those are businesses. Those are majority of them are SMEs. So there's nothing going on. And you've even seen debates with parents asking, what services should we pay? Even those children are learning at home. So parents are challenging a lot. And of teachers, for teachers to be able to do education, there's work and they've got to be paid, etc. Least hit, I think, is agriculture, because people must eat. And even though transport has disrupted, I think innovative ways are coming up. You find buses. The other day, my sister's mother-in-law was sending her fish, and they've conducted, just like KQ was doing cargo. So they're also doing cargo. So that there's some innovation coming in there. So I think those that shall survive are those who will be quite innovative.
Interesting, because you are bringing in an element of variable cost vis-a-vis fixed cost. How are SMEs looking at this now? And even before you answer that, maybe I can take you back to, are we in this space where we have to be innovative in our thinking, especially for businesses in that sector because of COVID? Or are there underlying problems that have just been bubbling underneath the surface that have been brought to the fore by COVID?
I think innovation is there, but constrained by the underlying problems. If you look at, speaking as a banker, from 2014, non-performing loans have been rising. And the larger sector that's financed is, if you looked at banks' books, how a bank defines an SME. And rising non-performing loans means businesses are struggling, because that's the source of repayment. So there's been underlying reasons. So there's generally been, the business environment has been declining since 2014. But I also think SMEs, in terms of the character of an SME, if you could call it that, is one of not, putting aside something for the future, which can then finance resilience, can finance innovation, can finance, quickly moving from one thing into the other. Micro enterprises might be easier in terms of innovation because there's very little cost of moving from this to that. But when it grows a bit larger into a small or a medium-sized enterprise, then they need to have put aside a cushion to enable them. For example, somebody who has a fleet of buses, be able to remove those seats. And it costs him money. So if the business has been living from hand to mouth, for lack of a better term, where all revenue generated is expended and any profit is expended by the entrepreneur, nothing is kept for the future, then it can't respond to such opportunities. So those have been the underlying things that the SMEs will have to think about now during COVID-19, and when we surmount this COVID-19 challenge, of how they will be able to respond to circumstances that are either systemic or are beyond their control, or the control of anybody who would support an SME.
Such, key themes that you're bringing out in this last segment that you've answered. There's the element of cash flow management, and I do know that when we are speaking to individuals, the rule of thumb is keep aside maybe 3 to 6 months cash flow aside as your emergency fund for your operations. But what COVID has shown us, both locally and globally, is there are businesses that just could not even survive with a 3-week closure. In your experience, either extending credit to SMEs or engaging with SMEs, training them, or in whatever capacity, is it a normal occurrence for SMEs to always have that emergency pack? And if not, how should they look at it and how should they consider building it up after COVID?
It's actually not normal. It's I think one of the peculiarities of SME is living from day to day. those that have survived, every year you get the statistics of how many startup SMEs survived into the next year. When I having in my career, I've seen that those that have survived have they build a safety net, whether in the form of savings, cash savings, so that the entrepreneur must be very strict about that, whether in the form of investments that they can then liquidate in the future. Diversification also sometimes helps, whereby an SME can diversify into a business or assets that are easier liquid than others, for example. So that's something that I think in our SME sector needs to come up with. While I think Parliament and Central Bank were considering discussing and with KB as well to convince Parliament to remove interest rate caps, I think one of the assurances banks needed to give is financial literacy to their customers, to their micro, small, and medium enterprises. So I think that's one of the things that SMEs need to tap into, whether the literacy is provided by your bank, by non-governmental institutions out there that in CBK itself or whoever. I think SMEs now have to open up themselves to operate more structured, like corporates that have existed for a long time. Why corporates will survive seasons and cycles is having that cushion and safety nets, which helps manage cash flows. So that during times that are good, when your margins are either higher or revenue is higher, and know that this is a cycle and you're in a particular stage. So I think there's a lot of financial literacy that is required that SMEs need to be open to and actually put into practice the things that they gather.
And now, talking about some of the measures that have been passed by either the government, through the central bank, or through the different ministries, one of the proposals was for businesses to be able to have a conversation with their banks and defer their payments. How are you advising businesses to either start this conversation, or what trigger points are you telling them to look out for so that they can then have this point of caution that has been proposed as a measure by the government?
I think in terms of trigger points a business has to be proactive right now. And even those that are doing well right now have got to ask themselves, nobody knows how long this thing will last, when it will settle, when we shall surmount it. So it's to look at their businesses and ask themselves, if this thing were to survive, 3 months from now, 6 months from now, 24 months from now, will I be able to continue? The first thing is, will I continue to generate revenue? Because when revenue begins to decline, those are signs that a business is dying. Margins may decline, a business may make losses, but when revenues are sustained, then the business is sustainable. So they need to really look and see, is there something that will affect my revenue? So long as revenue will be affected, and I think it's time to have a discussion with your bank early, not rush when everybody's rushing. If you look at what banks are now doing for personal and consumer customers, is because there are so many, even getting into the point of being restructured. Walk in, say that I have a salary cut, or I've been laid off. So the first thing banks are doing is giving a moratorium of some period, 3 to 12 months, so that then we see what is going to happen next. Then thereafter, the borrower can decide whether they think they shall keep their job or not, or they will get another job or get into business. For business people, where majority are SMEs, banks are open to restructure. So I think right now, even if an SME is not sure, is not able to look at those fundamentals, your revenue, your margins, your costs, demand for your product, etc., I think it's a good time to walk into your bank and talk to your relationship manager, whoever serves you, and look into this. Something called an annual review. You can ask for an annual review from your banker. I think one of the monetary policy things that CBK and KBA have discussed is that banks bear the cost of restructuring facilities. So when a customer goes in and asks for a bank to look into its business, and they both look at its viability in the context of COVID-19, banks are not going to charge for that. So
can you still hear me?
Sorry.
You at the point of the banks taking on the cost of restructuring? Maybe you can pick it up from
Yes.
there.
Yes. So now that banks are taking up the cost of restructuring or rescheduling or, whatever format of your loan to give customers some reprieve, customers need to walk in there. Anybody who has any amount of uncertainty to walk in, talk to their banks, and so they can all both look ahead and decide how to restructure the loan to survive this. Some may not be new borrowers, but then, between themselves and their bankers, they can identify that there's because there will be some sectors that will gain during this season and determine that there are opportunities. The only thing that this business lacks is either capital or cash flow. And then banks can structure something for them. So I think it's one of those unprecedented times when banks are very open to discuss anything. And so CBK is on board, banks are on board, so even the SMEs need to be on board and go and approach their banks and have those discussions early.
Have those discussions early. That's one element of the fixed cost. That's the debt obligation. What about fixed costs such as the cost of renting outer space, cost affiliated to your cost of labor, your cost of fixed assets? How would SMEs then approach the permanent or the cost that they have to deploy every single month, either during COVID or after COVID?
Yes. And I think that now goes into cash flow management, is to determine the level of activity in your business going forward. That's post-COVID. There's no COVID. So a business, the level of activity that will generate revenue that pays its most important. So looking at its fixed costs, what fixed costs can you not do without? If you're a restaurant and you think your restaurant is viable, except for this season of COVID-19, then you need to pay rent. So whatever you generate or you invest in it as a business should be able to pay your rent, a couple of months ahead. And I think going forward, we're not going to be talking about 6 months. I think we're going to be talking 12 to 24 months ahead. So that earlier, when you see that you cannot cover month-on-month cost, then you can decide, do you downsize, do you sublet, if possible. In the case of other costs such as staff, etc., then I think this is time to determine how lean to be. And then you can have a discussion. There was a time, like hotels, for example, go through 3 seasons. They have peak seasons, they have high seasons, and they have low seasons. So a couple of hotels would then usually tell their customers, we are getting into the low season. Once they're off the peak season and the high season, they say we're getting to a low season. So this is the deal. We lay some of you off, but we're offering you employment when the season peaks, or everybody accepts a pay cut so that we save each other's jobs. So those are discussions that SMEs are going to have. Just like corporates do, SMEs are going to have to care about their staff and have very candid conversations and let in their employees in the decisions that they make, which makes, if you out in terms of training or orienting your staff, then you can get them back if you let them go, if they agree to go, or if they have lower salaries, so that somebody doesn't come and take them off you if they can pay them higher salaries. It creates loyalty and passion in your staff. So that's a way you can, of the bigger chunk of costs, which of course, of fixed costs, which are rent and staff. Yes.
2 more questions just to ask, because now you have given us a sense of the fact that SMEs need to be very proactive, and cost rationalization is really the paramount discussion that they need to be having at this point in time. Is there any other key consideration that SMEs need to look out for in this time, and also just going forward, especially in light of looking at the business environment, which, as you have mentioned, could be positive or negative for some businesses depending? Is there any general point of reference that SMEs can pick in as far as either pivoting their revenues, or what else can they do over and above cost rationalization?
I think the other thing is, and I know it's difficult, especially when you're looking at financing from a development finance angle, is SMEs have got to increase their transparency to whoever their partner is, whether it is a bank. With banks, it's much more difficult for SMEs, because I think a lot of people feel like the more information I have, I give a bank, when things are thick, then the bank will come after me. And that's what corporates do. Banks lend corporates and individuals with lower security compared to the amount that is lent. So that's what SMEs need to do to take away the risk. So more transparency, and more transparency means they now have to step up and keep records. Records don't need to be sophisticated so long as they are there. The other thing is, I think the character of the entrepreneurs or the people that are running the businesses, they've got to build trustworthiness. Even as banks are trying in terms of discipline, transparency, and information, I think the other players in the financial sector are the partakers of banking services. So that between SMEs and banks and anybody who would want to partner with them, including customers, is they've got to now begin to build more transparency. Banks, I think before, if you look at 2007, 2008, the financial crisis, banks credit grew. Credit grew despite the things that we went through. Even when Kenya went through a struggle in 2011, 2012, credit still grew. But credit declined from 2016 when interest rates were lower. And it was banks citing the credit risk of customers, and especially SMEs. But I think it's not that they don't want to support. If banking services is one of the ingredients or inputs to at least the success of an SME, it's just the issue of a customer needs to know, a bank needs to know, so that even when it's taking unduly high risk, at least everything is on the table. So they know what risk they're taking from the onset. So that's one of the things that has made, I think, when SMEs are not transparent, even the entrepreneur cannot keep up with the, the triggers. They don't get to record and identify the triggers that would either be successful or fail. So I think that's one of the things.
And I think on my final question before I take your parting shot is, when we're looking at the financial sector, especially the banks, and the incidence of non-performing loans. I did look at a cross-reference looking at China where COVID started, and the data that was coming out there said the NPL ratio, I think before COVID happened, was less than 1 percentage point, but then after COVID it shot up to, I think, about 3 to 4 percentage points because businesses were locked down, there was no demand, supply chains were disrupted. If today we are at 12.5% in as far as the NPL ratio for the banks is concerned, what is your outlook or what is your sense in terms of how this could evolve? And then secondly, would this affect your universal banks, your big tier banks that have a lot of interaction with the SME and government, or would it affect some of your specialized banks that are more specific in terms of the segments that they engage with, whether manufacturing or tourism or etc.?
Looking at, I think between December and March, there's been a bit of improvement in non-performing loans. So even before COVID became a reality in Kenya, for example, non-performing loans ratio went down from 12.7 to 12.5. So that's a good thing, which indicates that were it not for COVID, we might have been improving. I think even in terms of the country was projecting higher growth, I think 6 point something compared to 5.6 last year. So that also, you can see impacts non-performing loans. So I think it might improve right now that it might improve from the way banks are being allowed to classify loans after March 2nd by CBK. You might see it plateauing at either 12.5 or beginning to reduce as customers prove that they've been affected by non-performing loans. So there will just be regular structured loans, but with longer cycles of repayment, softer terms of repayment. Loans will actually not be classified as non-performing. That might help the ratio plateau or actually reduce. But I think as there's much more collaboration between SMEs and banks, where SMEs are becoming more transparent, because you can see CBK is really intervening. And so through monetary policy, it's really helping, by reducing the CRR, which gives banks more liquidity. That will help banks lend those who were not, would not access because of credit risk, because everybody's going through a risk. So if you were to consider this systemic risk and remove it, then banks will look at other things. And the more liquid a business is, I'm sure the more it will trade and the more it can pay its debts. So for me, I'm positive about it. I think the outlook is positive. so long as the government increases the measures. Yeah. So just apart from the fiscal and the yeah.
Any negative impact on loan loss provisions or earnings in the banking industry in general from your observance of how the economy is doing?
If the economy were to increase as earlier projected, then I think it will be improving. Somehow they normally flow together, except the soft issue of character, where it's not an issue of economics, issue of character. But I think at this time where there's so much solidarity of we're in this together, all of us are in the pit, let's get out together. So I think character is going to improve. The character of banks in terms of looking at their customers, and the character of customers in terms of being transparent with banks. So I think it's going to improve. So for me, I'm very positive about it. Yeah.
I think that's all the time we have. Maybe you can leave me with one parting shot, anything pertinent to this conversation that we might have omitted in our earlier questions.
I think I'm very excited about CBK's push for the National Treasury to provide credit guarantees for SMEs borrowing. I think the banking sector has been pushing for this for a very long time because, as you know, the CBK through the monetary policy has always pushed for increase of production, increase of contribution of SMEs to GDP. So, but the thing that has prevented banks from lending, even when you have good SMEs, is credit. Is collateral or security. So they've been unable to because the same CBK, in as much as it pushes for lending to SMEs without collateral, also requires order, in terms of growth of non-performing loans. It doesn't look good on banks, the financial sector, and the economy. But I think once government can guarantee that, I think there's be a lot more penetration in terms of lending to SMEs, and things are going to actually improve for SMEs. So for me, that's very exciting. I hope it happens soon. Yes.
All right. Thank you so much, Christabel. I think this is one of the interviews that I have seen a lot of optimism and a lot of excitement. And I guess you're telling us, you know what, the glass is literally half full. We can do better. So we appreciate your commentary as well as your guidance for SMEs. And thank you so much for the positive note. We will end it there. As always, thank you for joining us. We hope you can join us once again, same time on Markets Today. Good day.